What's going on, everybody? Welcome to the stream here. We just went live. I'm pretty sure we're live on Twitter as well as, or X, as well as YouTube here. Thank you guys for tuning in. Let me go ahead and check the chat here. Is YouTube live? Gonna check it. Yeah, YouTube is good. X is good. We're good to go. So again, thank you guys for tuning in. This is my boy Josh. Known him for about 4 years now, and a great guy, an awesome person. And he'll tell you a little bit more about himself. But he's had a great tra- trading journey here, and he's done awesome. So, Josh, why don't you go ahead and introduce yourself, and we'll get this thing started.
What's up, everyone? My name is Josh. Watch Josh Trade on Twitter. I've been trading for about 5.5 years now, since 2018. And I started trading when I was in grad school, but I can save the details for later in the conversation if you'd like. But I am also a full-time lawyer, so I was trading while I was in law school. I was trading while I was in grad school. Traded full-time for 1.5 years, and now I'm full-time at a job, also trading, trading here and there, mainly maintaining my charting and tweeting presence in addition to trading on the side. But today was a good day. It's good to be here. Thanks for having me.
No worries, man. Awesome. So we'll get this thing kind of started. Really, the point of this stream is to give you guys some absolute free gems that you guys can take with you guys. Really get Josh to talk about his experience and how well he did in his trading career, what worked, what didn't work, what he really started working with to grow his account from 2000 to which he'll explain what he got to. But really just the little tips and tricks that you guys can take and just really understand that you don't have to shoot for the fences right off the bat. Consistency is what's really important in this business. I'm sure you guys have all heard throughout, your trading careers, and risk management is huge. Okay. Key little things here and there is working on, obviously technicals, what to look at, what strikes and expiries to choose. A lot of the times people are choosing strikes and expiries that, are not meeting their actual trading goals. So they're getting theta or IV crushed and whatnot. So Josh will explain all that. He'll share his screen. If you guys have any questions throughout the live stream here, go ahead and throw it in the comment section or at me on X, at Josh on X. I'll get to it. I'll try to answer them live on the call while we're here. We have about an hour. We're gonna hammer through this, and we'll get this thing started. All right. So I'll give the stage to Josh here. Josh, when you're ready to share your screen, let me know, and we'll get going.
So I feel like I should give you guys some of my street cred first before you listen to anything I have to say about investing or technicals or anything like that. I started trading in the end of 2018, and not many people on X were around in 2018 trading. There are a few, and they're worth following. But for those of you who weren't there, who don't know, the end of 2018 was a bear market. I had no idea what the word bear market meant in 2018. And I just started with $2,000. And when I sort of started with the idea that I was going to pay the tuition fee of a junior community college class. And that's how I treated my account. And I lost $1,500 in about 3 months, which actually was more of a slow burn. And I realized that in that time, I had absolutely no idea, what I was doing. I had, there's a guy on YouTube who I watched his videos of, but I realized he didn't know what he was doing either. And so what I did was I joined a community on Twitter. It was Twitter at the time. And I found people who were doing trading in a way that I aspired to do and aspired to be. And I joined one of their Discord rooms. I'm not in that room anymore. Everything was completely free. I never paid a cent for education. I educated myself off of other people's knowledge, like you're doing right now, listening to us, and also watching videos on YouTube, reading books, and then reaching out to people in the field who I thought were doing really good work. And so I started in and then I started back again in 2019, toward the summer. And 2019, I started with the $500 that I didn't lose. And I turned that $500 into, by the end of 2019, so turning 2020, into around $5,000. And this was a really crazy time. I remember the trade. I was trading with my friends at the time. I was on Robinhood as well. And I was trading based on these insane moves that Tesla was having at the time. And that's when I started to learn what liquidity was, like what the options chains were, and I started to experience in real life. So I can pull up the Tesla chart, but I just wanted to show, like, in 2020, I keep very close track of all my investment accounts. And this is like when I transitioned from Robinhood to Thinkorswim, I started to create a chart, and I have 5 years worth of data of charts. You can see it here. I actually started with 500 to 5,000, but I just started in my TD Ameritrade. And then over the course of the year, I ended up growing that into around, $43,000 that first year. So I made 54,000. Along that time, I had an outside investor, and I made him around $20,000. So I'm not counting that in my personal profit and loss. And then 2021 made $44,000. 2022, I made, let's see, $56,000. 2023, my first down year, except for the first year, I went down 18%. So I lost 26,000. That was my first down year. It was a really rough trading year. And then this year I'm up 100%, which is kind of crazy. But I actually took out a ton of money from my account. I've withdrawn over like $70,000 of my personal profit, but I'm still up over 100% in my account. So I've had a really good track run. I think that if you were to just calculate my track run, it's some obscene number. It's like, it's really hard to calculate, but it's something like, 17,000% over the last 5 years.
There you go. And he had a drawdown year in 2020.
And I had a drawdown year. So basically, my $500, in personal profit, it's actually over 150,000. And then, but you take out taxes and fees, of course. And then I've made other people around 100,000. So altogether, I'm gross over 250. But yeah, so that's where I started out in terms of my street cred. I think the most important thing, though, that from my story is that it didn't all come in one, Wall Street bet. I think that people like to show, these really insane gains and turning $5,000 into $500,000 in one night. That's really cool. I think most of those people who post that will lose it over the next 4 or 5 months or whatever, because they're going to keep trying to reach that level of, high or whatever. I think what's cool about my journey is that I have done it consistently now for 4 years out of 5, consistent returns. So I think if I were to talk about my journey, it would start with me learning really simple technicals. And by simple technicals, I mean something like supply and demand. And so I think that, Ali, this is what you teach, your people, supply and demand. It's very simple. It's supply and demand is a very easy concept for people to understand. It's where are there sellers, and where are there more sellers than buyers, and where are there more buyers than sellers, right? And so when you look at this chart, you can just see at this level right here, there were more sellers than buyers. And that's why the chart turned down. And down here, there were more buyers than sellers. And that's why the level came up. So you would just draw a little line right here, and you would just mark out. This is very basic. I'm just talking this is your kindergarten trading right now. You would just pull out this line right here, whatever, and then you would be able to mark that out. And so I used to do that on so many charts, just watching. And I think I can show a little bit more of the technical side, but I really wanted to talk about 2 things. One is, and they come into one phrase, and it's about calculated risk taking. And one thing that I learned in my trading journey that I think was important, that's not talked enough about on X, especially basically in the community, is you have to be managing your risk. You have to be managing your portfolio account, and the way that, and it's about, but I'm talking about how you get to that calculation. It's calculated risk taking, right? So when the calculation side, what I do is I calculate it based on the levels that I'm drawing on my chart. And what I aim for always, I mean, people aim for different ratios. I aim for a 3-to-1 ratio, 3-to-1 reward to risk ratio. And people calculate that differently. The way that I calculate that is based on where my stop loss is. So like, let's just like look at this right here. Let's say like I'm entering here. I'm gonna turn this to the 1 hour chart. Ask any questions. If you have a different track you want to go on, let me know. Oh, I just changed this. But I felt like this is worth talking about. So let's just take this chart right here. Right now I drew a fib, and Fibonacci, one of my friends who I trade with, he actually got a fib tattooed on his arm.
No way.
Yeah, seriously. He's in the chat right now. Because of how important these levels are for our trading system that we use. And this 1.618 ratio right here, it's called the golden extension. The 0.618 is the golden ratio, but I can explain that in a second. But let's just say risk reward. You see Amazon right now is sitting at 226. The fib level that I drew, so my previous level that I drew is at 230. So what I would do is I would calculate that as a four-point risk ratio, 4-point risk level, right? Mm-hmm. So what I would look for is am I getting the appropriate 3-to-1 ratio? So I would need 12 points of reward in order to make this trade worth it from a swing trade perspective, right? This is a swing trade. And so what I would look for is 12. You just do simple math. I'm not good at math actually, but 226 minus 12, 214, right? So where's the 214 level? It's right here. And I actually haven't marked out any other levels on Amazon because I'm not trading it yet. But I see an actual level right here that's a little. I see that level right there. So I drew that level because you had a little bit of a supply here, and you had a little bit of a refill right here. So it's more of a range, right? But my actual level is 219. So that's not a good ratio in my mind. And so I'm actually kind of staying away up until I can actually trade it against this level higher. So like, let's say I can enter around 229, then I'm getting a 1-to-16 ratio. It's a really great ratio. And based on that, like, that's my first like insight into, do I want to take this trade? I'm not taking every single 3-to-1 ratio that I see. A lot of it also depends on other factors, which I'm happy to get into. But I think the first thing that I wanted to share, which was really like revolutionary for my trading, was thinking of risk to reward, not in terms of how much money you're risking and how much like return you might get on your investment, because it's really hard to calculate that with the options chain. Like, you know, IV, theta, there's a lot that can go into that, into calculating risk and reward based on the potential return. But if you calculate it based on fixed numbers, supply and demand, you are much more likely to take a high risk to reward trade. And so that was like really revolutionary, because I used to try to calculate things based on, you know, the options chart, based on, I mean, there are a lot of things that people calculate it based on, but this to me has been the most tried and true method of calculating risk to reward. And then there's a second layer, obviously. The second layer is how much are you risking from your own account? And what I will do is I have these rules that I have in place, you know, these risk rules. But do you have any questions about this like little 3-to-1 ratio that I built out before I talk about that?
Yeah, I think a lot of people always ask, you know, how do I calculate how much profit I'll make on an option? It's really hard to do when you're kind of basing it on a technical, right? It's more so it's more, I guess it's better to base it on a risk to reward system, just like you mentioned, because there's so much outside factors when it comes to an option strike or chain, right? You got theta, you got IV. So as long as the risk to reward is there, that's already positioning you in a trade that has, at least I call it, meat on the bone. It's got enough meat on the bone for you to be able to take advantage of that big move down, and your risk was a lot tighter too. So yeah, I like that as well.
Yeah. So I mean, there's one level to what you're saying is, well, what option are you selecting? And I know you wanted me to talk to
Mhm.
your
Yeah.
viewers about which option you're selecting. And unfortunately, like my trading view only allows me to chart it, but I can discuss it like more generally. But your
Mhm.
people on stream won't be able to see the chain. Um, Oftentimes what I do, it changed based on my account size, I would say, which is an interesting thing to note. I don't know if I would recommend it necessarily, but when you're at a $2,000 account size, you're necessarily capped in terms of your flexibility. Like you can't take close to the money options. Yeah, you can look at it. Maybe let's look at some Amazon strikes. Oh, perfect. Let's see this. Yeah, so like $2,000. So that's my first level is calculating risk reward in terms of the chart. My second level of risk to reward trading is calculating in terms of your investment, your portfolio size. So let's
Right.
say like $100,000. I actually had a tweet about this recently because someone was like, oh, you have to risk insane amounts in order to get the reward that they're talking about. I wish I could pull it up. But let's say you have $100,000 account
Mhm.
or let's say $10,000 account. Oftentimes the max risk that I will risk on a trade is 10%. And that's a lot. Oftentimes people preach 2%, 5%, but I feel like when you have a small account, you have to take more risk. Like you have to take more risk and you have to manage risk, and you have to understand the risk that you're taking, but you still have to take that risk when you're at $10,000. And so at $10,000 a risk, and it's a lot, honestly. Like I would stick more in that's a max, right? 5% is
Yeah.
more. That's a max. 5% is more normal. You're only risking that much when you see an A plus setup. And I would probably guess that most people starting don't understand what an A plus setup is yet. So I would stick around 5% actually. So 5% obviously is $500. And so the way I would calculate it is I'm actually risking $500. I'm not betting $500. I'm not only
Right.
choosing $500 worth of options. I'm calculating that. And so let's look at these strikes here. We have a 225. So I'm looking at the put side, at the
Mhm.
short side. So I would like, just with a $10,000 account size, I would probably choose, again, like based on this calculation, I'm seeing like, my strike level would be 220. I would probably pick that 225 strike. The closer to the money, the better. Or I would pick the 222.5 strike, one or the
Mhm.
other.
Yep.
And I would probably risk around, for the 225, I would do maybe like 3. And for the 222.5, I'd do around 5. Like that's if I'm trading a $10,000 account size. And the reason I'm just doing quick math in my head, that's why.
Yeah.
So like quick math in my head, 22.5, if I'm getting 5, that's around $700. And if my stop were to hit on my Amazon chart, which is $4 away, I know based on the time. So the time is it's Monday. We have 4 days left. I know that the decay on that, if we were to hit my stop, would be at least 50%. I think it would be at least 50%, probably more like 60%.
Mhm.
And you can look at you can look partially at the theta and the gamma in order to understand that. But the problem is that when you're trading at the level that we're trading at, I would not suggest that you need to read those. I've never read theta and decided to take trade based on theta. What I do look at is the implied volatility, which is on the right, on the
Yep.
right side there. There are times like this, for example, 2 weeks ago, we are looking at MicroStrategy, MSTR, and the implied volatility there was over 300%. And that is a terrible environment to trade in, because the moment the stock stops moving, you get crushed.
Yeah. And I tell people all the time, I'm like, when the IV is high and the stock could do absolutely nothing but stand still
Yeah.
for 10 minutes, you will lose probably 30% of your option chain.
Yeah, at least. I mean, like there's strategies to take advantage of that. And I think that,
Mhm,
I mean, like that's taking a step back actually. There's so many ways to make money in the market. Like you can make money by collecting premium
mhm,
on those options that are inflated in value because people are trying to move it in both directions too quickly. And that's a very valuable strategy, especially in this market right now, in my opinion. That's not the strategy that I use a momentum based strategy. And so like looking at this chart, I would look at the IV. The IV is pretty normal, I would say. Like, you know, you're sitting around 35%. There's actually charts you can utilize on Thinkorswim where you can look at the historical
and
implied
Josh, are
volatility.
you swing trading these or day trading them?
Yeah, so it has changed based on the life circumstance that I'm in.
Mhm,
When but I would say right now I use a mixed strategy. So,
mhm.
for example, today I took a trade that lasted maybe like 10 minutes.
Right, right.
But I also took a trade that I swung over the weekend. And
Mhm,
so I right now I've been cultivating that mixed strategy over the period of like 2 years because when I was trading full time, I mean, like on my live streams, I'm in and out within the first power hour. And I know that
yeah,
you preach that, right? Like you talk
yeah,
about how in the first hour of the trading is when liquidity is the highest, and that's when you
correct.
can capture the biggest move in the shortest amount of time, and that's when also when the options tend to pop off the most. So,
And
I
then
mean, like,
how do you I guess establish which expiry would you then choose? Are you deciding that before or after?
yeah. So when I use shortcuts because I wasn't trained in this in
Mhm.
terms of you know, there's some people who there's a science to it, and I wasn't trained in the science. I would say I do more art form.
Right, right.
What I do is I actually look at the open interest on the
Okay.
stock, which I don't think you have on your. Um,
Yeah, right here.
oh, okay, there it is. Yeah,
Yeah.
I look at the open interest, and I honestly I pick the ones with the highest open interest because those will be the easiest one. Those will be the ones to move the quickest, and they'll be the ones to be the most liquid when you're trying to sell.
Yeah.
I think that I've made a couple mistakes in my past or in a couple different trades where I picked options on the chain where the OI was 2 or 3 or 10. And what you if you don't know what that means, it means that you're buying into a market that you're creating. And so it'll be really hard to sell out of it unless you're really early and other people rush to buy the same thing that you're buying. But it's because we're trading at the size that we're trading, we're not BlackRock trading billions of dollars.
Mhm.
You want to follow your blockers. And I preach that all the time. I'm talking about following blockers. You follow the big money. And so when you look at the options chain, you look for the biggest number first, and those are the ones that I gravitate towards. It's really a heuristic. It's a shortcut in order to
Yeah.
understand which ones to pick,
Mhm.
but it's a lot easier to trade those ones than other ones.
Yeah, and what he's kind of explaining and leading to is that essentially this open interest, for those that don't know, is all these contracts. When you see 2100 here, that means there's 2100 contracts that are open that have still not been closed, right? So essentially, if you get involved in this, let's say you buy 100 shares, this number tomorrow is going to go up to 21,400, right? 21,400 tomorrow morning. That means there's going to be 21,000 people that are going to own this contract that are looking to sell, right? Essentially, there's buyers and sellers in that market. So obviously, the more buyer and sellers there are, the easier it'll be for you to get in and out of that contract. Versus if you go, for example, to let's do NVAC because I know the spreads on this are absolutely horrific every time. And we choose, I don't know, something like this. The open interest is 1, right? And the spread is
Yeah.
over 100% here. So, if you manage to somehow get filled, 50 contracts here, how the hell are you going to sell this when you're the only person who holds 50 contracts? There's no one else who wants to buy and
Yeah,
sell.
no one's gonna
So
buy
you're
that
going to
shit.
have a problem getting out of this, right? So that's what he's saying. So he's saying, if you were to choose something in this block right here, probably this one would be the best because you have 1,246 open orders. if we're just looking at this, right?
Yeah.
So open interest kind of guides you in. If you're a little bit confused on what to choose, that is usually one thing to look at. But like you said, usually the one that's right in the money or out of the money, these first two, three are probably the best ones to take a look at.
Yeah, and you mentioned another thing, spreads, that I haven't touched on yet. And again, like, I don't have a science, I have an art when it comes to picking my options on the chain. But if the spread is, let's see, I'm trying to think of it, it's like over 20%, like between the bid and the ask, I'm not going to pick it, because I've gotten really screwed trying to get filled on on the ask, and it bottoms out after that. And what I mean by that is, when you play a momentum based strategy, you're pressing the buy button. You're not sitting waiting for your order to be filled at a certain level. And oftentimes, like, I buy when I see the breakout or I see my level hit. I buy like at the immediate level that my level hits. And if you are buying on the ask, you want to make sure that the spread is close tight enough. Yeah, there we go. So this is actually a normal spread. I would say 20% to the middle, which is like,
Yeah, this is not bad.
it's okay. It's
But to
not.
kind of visualize it, let's go back to that NVAX one, right?
Yeah.
Where was this? Let's just choose this for example, right? Some people have a hard time wrapping their head around looking at it horizontally like this. So I like to kind of put it in a vertical format. So, on the ladder here, you can see the sellers are here at 136, and you got to scroll all the way down here to where the bid is, right? So this right here, by you just glancing at this, you can tell this is wild. This is a huge spread. And then
Yeah.
to put it in perspective, when you're looking at, for example, SPY, look how tight the spreads are here. Right?
Tight.
It gets a lot closer. So the gap between the bid and ask are a lot tighter. So when he's saying the spread is no more than 20%, that means he's really just saying, okay, if this is 117, then 20% of that is the max that he'll look at. If it's more than that, he won't even take that trade.
Akash likes the chart for the options, the option chart, which can show you like the historical.
Yes, I can actually do that too. Give me a second. Let me pull it up for NVAX.
Yeah, it's probably horrible. I mean, like, you probably have like two people buying, and it looks like a line chart, but
Yeah, and that's the other thing too. It's like it tells you, well, it's hilarious. All right, share window. There you go. So for those of you that want to look at an option chain chart, all you're seeing is dots.
Oh my goodness.
Right? This is horrific. A normal options chart should look something like this, just for the record.
Yeah.
Right, where you actually have candles. This is starting to get a little light too, but yeah, you'll have just regular chart, like regular chart, essentially, with full candles and so forth.
Yeah, but you can see in the morning, of that chart you just had, the candles are the biggest. It means that there's just simply more volume in the beginning of the day than there is at the end of the day, until like maybe the last 30 minutes. And so it's really important for people who are just starting out to know. I used to when I was full-time trading, or before that, I used to have a rule even where I would not trade between 12 and 2. Like, it was just like those times were lunchtime. I would go for a run, I would work out, and every trader on Wall Street also like goes to work out.
Yeah, they're all off their desks.
You got to follow your blockers.
Perfect.
Yeah.
So yeah, I think the options is a open interest is valid, is a great thing to look at, and obviously one or two out of the money is the next best thing in regards to selecting. Perfect. Now, I guess tell us a little bit about how do you bring stocks to your attention? Like, what makes you? How do you scan for stocks? What's your routine there?
That's a really good question. Maybe we pull to my screen share here, and I will show you like what I do. Like, let's just say that this is my chart review for tomorrow, right?
Mhm.
Like I'm just
Mhm.
like scanning for tomorrow. So the first thing I notice, you have to draw lines on your charts.
Yeah.
There's no way around it. And so I have a watch list here. This watch list, I've cultivated it over time, and I tend to go with very liquid names, blue chip names, and I'll take them out if they're not. I mean, like, and then some like bellwethers being like they can tell me how the market is doing in a certain sector. So like Ford is not a liquid name, or it is liquid, but it's not a mover, but it'll tell me how the market is doing in general. So I constructed this watch list over time. Um, and I simply just go through it, and I use my eye to be able to tell. And I don't like trading airlines, so I just have them on here in order to understand where the market is at. But let's just go through a couple, and I'll tell you what I see. So the first thing I notice here is that Apple has broken out of a consolidation, right? And there's some nice momentum candles. So that's the breakout, right? That was the breakout, like right here.
Mhm.
I have a target that's a little higher. That's 251. And that's based on these Fibonacci levels that I've drawn. And that to me, like, is a little too close to milking the ratio, like the risk to reward ratio that I was talking about, right? Like I only have 5 points there. The risk would be the low of day of the previous candle,
Mhm.
which would be 241. So that right there, oftentimes it's hard to do it when the market's not moving exactly, but I will oftentimes mark out in the first 15 minutes an opening range, and this is it's a very common strategy that people use. It's opening range breakout, and so in the first 15 minutes, you analyze where the price is moving. So like, let's say like this, in the first 15 minutes, it drops down to like this level right here that you see in this like really quick 30-minute chart.
Mhm.
I would use that. Like if I was trying to trade this, I would like calculate my risk reward based on this level. Like let's say my plan, I'm set to planning, based on this chart. Okay, if it comes down here, I can take a trade, but then my exit would be down here. It's not actually a good trade in my opinion. Anyway, so I just I gave the risk reward concept earlier. That's the first thing I'm looking for here.
So do you have a set of stocks that you're constantly checking every night?
Every night I check this watch list.
Got it. Okay. So you've built yourself a list of stocks that are like your go-to stocks that you're constantly looking at for a setup.
Yeah, and there's that. If you don't want to go through more, that's fine. There's that, and then there's also, I am on Twitter, and people like to, or I'm on X, and people like to hate on X, or on like social media or Reddit, or even like they think of like X as Wall Street bets. Like people who
Right.
are outside the bubble, they're like, oh, these people. But no, like I follow people who are legitimate traders and
Right.
who are also tracking the market. And oftentimes, like sometimes you're bringing to attention a chart that looks good that might not be on my list, or that I might have overlooked on my list. And so I'll go and I'll take what they said, and I'll double check it against my own work.
Yeah,
So
exactly. I think that's important. I think every source that's available to us is a good source, as long as you're able to do your own thinking on it, and pull it up, look at it, see if it even matches your thesis and idea. Because there's a hundred different people out there trading different systems and strategies. Um, as much as we love everyone, some of them can be great traders. You, at the end of the day, have to find value in what the idea that they're giving, and then if you do, then I think it's good to kind of track, which is awesome. Since you build your own list like this, you can kind of put it on that list and see maybe down the line it sets up something that you like better.
yeah, I follow a lot of, I get newsletters from hedge funds, and
Mhm.
there was one that was just released. I think it's C3 or YC and then C3, and they talk about themes. And what I'll do this is the second set, like, so I have my first set is my own watch list. My second set is looking to
Hedge
people
funds.
on X, is looking at people on X. And then my third is looking at what hedge funds are buying. And I will oftentimes go into these new ETFs that they're constructing,
Mhm.
and I'll look at their filings and see what positions they're buying, and I'll go through the charts on those as well, because oftentimes when institutions are buying stocks, like it's the precursor to a big move. And there was one ETF that I added to my list recently, or there was one that I added to my list recently. Oh shoot, I think it's on the bottom of this thing now. Yeah. It's interesting. It's down today, but I was following this. This is not an ETF, but this is a stock that was in the ETF, and another stock that was in the ETF was this one. And I was looking at it, and they were talking about sort of like robotics and gene therapy, and this one was one that an institution had been buying last month. And so I added it to my watch list, and literally today it was up 120%, which is crazy.
That's interesting. So how do you get access to these, I guess, institutional newsletters?
Yeah, so they're free. I mean, they are required to report what's in their 13F filings. And so you can actually go to their website, their landing page, and look at the documents that they're producing. So that's one way to do it.
Awesome. Give us some names.
Give us the name of an ETF.
No, of I guess one of the hedge funds that you're kind of following. We'll
Yeah,
pull
I
it up.
follow BlackRock's hedge fund. They create so many different investment vehicles, and then I also follow the ARK investment vehicles. I don't know if you're familiar with Kathy Wood.
Yep.
But she was really up in 2020, 2021, and then she's been down. But I think that she has these themes for each of her ETF portfolios, and I think that within the themes, they have become increasingly relevant. And so I look to see what she's adding, even though like she's had in the last 3 years a really bad track record. It's still worth it in order to capture new names, because like what I do is I track my names like every day. But in order to get new names, like the best way to do it is to see what other people are buying. And another name that came up in, like, for example, Kathy Wood's ETF, oops, that was the wrong one, is this one, which was like a popular name in Fastly. It was a popular name in 2020, 2021. And you can see that it's really beaten down. But I just added this back to my watch list. And you see like that the institution has been buying right here. Look, there's so much institutional buying in this stock. It's actually kind of crazy. Like look at these big volume candles right here, right there, right there, right there, right there. You see these little green lines underneath my chart. Like that to me is a sign that there's institutional accumulation. And I think one of the things that has been sort of pounded into me is that institutional accumulation is a precursor to bigger moves. And this is like a new thing, I would say, within the last year that I've been learning how to do. But I think it's been pretty profitable in the last like 8 months, I would say.
Yeah. So I'll say something. I have a gentleman in my program here. He talks about those big spikes of volume.
Yeah.
Calls them highest volume ever. Essentially, when you're seeing that at a chart at a bottom of a chart like this, when the stock is doing nothing but plummeting, and all of a sudden you see a huge spike like that. That's not retail. That's not me and you buying and causing that huge spike in volume.
Yeah, no way.
Huge abnormal volume spike. You guys want to pay attention to these things, especially in, I guess, some of your longer term portfolios. If you're looking to find a stock that, might turn around, might bottom out, you can always put that on your watch list. And then when that biggest, highest volume ever comes in, look for a technical indicator. Maybe look for you moving average crosses, right? See if the 20 will cross the 200. And at that point, maybe you can start a midterm position on, right? Those highest volume evers are going to be your key indicator that funds are pouring in, right? This chart right here that he's showing you has it almost 1, 2, 3, 4, 5, almost 5 times near the bottom, and then you get a double bottom breakout, right?
Yeah, and like the way I would, sorry, go ahead, keep going.
No, I was gonna say very good point. Those spikes in green volume at the bottom of the chart is very key.
Yeah, and I didn't trade this, so that disclaimer. But the way that I would trade this is, you see that there's supply here, right? This is where it sold off previously before hitting this. It went down almost like 50 or like 40%. So that's where the sellers are. Once it gaps above, these sellers are all trapped. And so I have like my macro environment. I understand where I'm at in the chart, in the name. It's like, you're walking into a new city, right? I know where I'm at in the city. I got my Google map, and now I got to figure out how to drive the car. And so I'm looking here and I see this big spike, and I don't buy on this spike. I almost never buy on this spike. I think it's a very bad strategy to buy on the spike. You know why? Because the IV is always inflated and you're going to get screwed. We talked about that earlier. And so what I look for, and what I tell other people to look for always, is look for this inside day. And you see this inside day right here. It's a nice little double hammer right there, little lightsaber. And that right there is a really good signal, because what it has done in this moment is it has stayed above this key level. If the lightsaber were to dip below, I'm out. The sellers have taken over again. But as long as it's above, the sellers are trapped. That is the day that I would look to buy an option in this name. It doesn't even have to be, it could be stock, it could be option, it could be whatever. And I would look for the break above that candle right here. And so the break happened. It didn't exactly happen. It happened basically yesterday. And that's when I started paying attention, was this weekend, unfortunately. But this hits every single, you have, like you said, the 20 crossing at a 200, you have the inside day. This is a really beautiful chart to look at.
And you also have a gap on the daily.
And you have a gap on the daily. I mean, there's so many things going for you on this chart that I think it was really beautiful. Now, would I trade this right now? Probably not. I would draw this little line here, and I would show you that this is where the next level is. And you do your little risk to reward analysis, and you would see that this right here is at 11.50, 11.30, and this is 60 cents higher, and you have about at least $1.30 in risk. So just basically to the last candle. I mean, you could even do it from here, but it's still not a good ratio. So I mean,
yeah. Now, if this was, let's say this was down at around that 950 area, right when it crosses that 200 moving average, on that rest day that you mentioned, looking at that day, would this be something you would choose a few weeks out expiry to try to get that move up? Because at that point, you have a good risk to reward.
Yeah. So I personally would choose a layered strategy approach. And by layered, I mean, I would choose some weekly and some monthly options, which we haven't talked about yet. But I have done that more recently because I'm mainly testing what are the best ways to trade these types of moves. And I have found that the weekly options are actually the risk, the reward that you get for the risk is actually pretty high. And so you can do 30% weeklies and 70% monthlies if you have the account size for it, and you can really capture a lot of the move. And so I would have traded it. This happened last Wednesday. I would have traded not that Fridays. I have a rule where I don't pick same week options after Tuesday. So if it's Tuesday, I'm not trading weeklies after Tuesday. I'm only trading it on Monday or Tuesday. But after that, it's the next week at the minimum, or it's the monthly ratio, the monthly chain. And so I would have chosen this Friday's expiration, which I think is the 13th, and also maybe even the week after that, which I think is the 20th, and that's the monthly expiration. So that's how I would have traded this if it had come on my radar before then.
Perfect.
Sorry, go ahead.
No, I was gonna say that's awesome. Okay, so we had the three things that we're looking for, right? All that stuff has got to hit. You have your watch list that you're constantly looking at. You have the hedge fund newsletters and the themes, the volumes. All that stuff is kind of the things that you're looking for to bring it to your attention. Good.
Yeah, and I would say that I have one thing that I've learned, and I'm still learning more recently, and this is a more granular trading style thing. I have a bad habit, and you have to recognize your bad habits, right? When you're trading, like part of part of the reason why I like trading is the mental game behind trading, and sort of
Mhm.
like understanding you get to know yourself really well. Um, and I know that I have a bad habit, and so does a few of my friends, of buying stocks in anticipation of them breaking a certain level that I have. So let's say like I see consolidation, and like let's say today, I don't have a good example off the top of my head, but like there was a time in my life, in my trading career, where I would have seen this very strong volume in Baidu,
Mhm.
and I would see it approaching here, and instead of being in here and exiting at my level, I would have added more here in anticipation that it
Mm.
would break. And that's not a technical error. That's a mental error,
Right.
right? That's you not trusting your levels. That's you not understanding how your levels work, and you not executing properly. And I would
Mhm.
say that I lost tons of profit
Yep.
by not taking profit at my levels, and instead just like sitting in it, adding, like doing all that stuff. And so I would say like one thing that I've learned is how to chart, but also how to trust my charting skills. And that has been really important to me in my trading career, because it's really easy to get caught up in the moment when you're trading. You see those numbers like start to go up on your screen, right?
Yep, that happens. That's happened to the best of us.
Oh yeah,
And anticipation is something I think I don't know. I think every trader still does it. Yeah, no matter how I feel like no matter how long I've been doing this for, to this day I still catch myself, anticipating that breakout. And it's
yeah.
almost like the market's like, haha, you did it again, sucker. Here, take your L.
Every time,
Every time,
every
every
time.
time. And it's I don't know why the next time looks like it's so much better, but anticipate again, and then boom, the exact same thing happens. And I'm just like, well, when am I gonna stop anticipating? So it happens to the best of us, but you're right. We just
I have,
have to get it, just let the charts show you, man.
yeah,
And
trust.
trust your levels.
Yeah, trust your levels. I have this rule also, like just talking about we should talk about psychology for the last 15 minutes, I think, because I think
Yep,
it's really important once you get into it.
definitely.
I have this like rule that has developed over time. A lot of my rules come from mistakes that I've made. Like you make a mistake, you build a rule into it so it doesn't happen again. And I think that that's a really important process that will help you in a lot of different areas of life, not just trading. But I have this rule where now, if I feel the urge to take a screenshot, and I do in fact take a screenshot and send it to my friend, I take profit. And the reason why I do that, it's a silly rule, but it works so often, and it's actually insane how often it happens. Where there's been so many times where I've taken a screenshot of my profit and I sent it to my friend, and literally an hour later, maybe even like half an hour later, it's gone down to half, even like less than half.
Yep.
Than what it was at the peak. And so now I have my screenshot rule, and I adhere to it. I had it today actually. It's a good thing, right? When your screenshot means you're making money. So
That's right.
I made a lot of money on these Chinese names today, and I took a screenshot, and my friend immediately said, "Hey, make sure you sell." And I said, "Already on top of it. Like I already sold that before I sent the screenshot."
100%, because the psychology behind it is if it's good enough for you to share, it's good
Yeah,
enough for you to take profit, right? And that's huge. A lot of people will take the screenshot, be like, "Bro, look at this! I'm up 300%," and they're boasting and they're excited about it, which they should be if they're seeing those numbers. But at the
yeah.
same time, you gotta understand what the market is and where you stand, right? Like you said, if you're taking a screenshot to show somebody, chances are you should be selling.
Yeah, definitely. Do you have any of those funny rules that you do when you're trading?
Um, I mean, yeah, the one main thing that I always, have told myself is the psychology portion of trading really comes from knowing yourself, and your abilities to do things in your personal life as well as your trading life. So for me, discipline really came when I started changing the discipline of my eating habits and workout ethics.
Yeah.
When I started, I was horrific in trading, as we all were at one point. But when I got a grasp of how I did things in my personal life, that transitioned into my trading.
Yeah.
Discipline's got to start from somewhere, and the more you can show consistency in one aspect of life, it'll spill out to the trading side of things as well. And with that said, you mentioned, you made rules based on the mistakes that you've made, right? I think a lot of traders that are new, they neglect how important tracking your trades are, right? If
Yeah.
you don't track your trades, you're not going to know what mistakes you're making. Thus, you won't be able to make rules to prevent those mistakes from happening.
Right.
So it's very important to track. Josh does it. I do it. Everyone I talk to does it. Because let's be real, I forget what I ate 3 days ago. There's no chance in hell I'm going to remember the trade I took, you know, 48 hours ago. So by tracking, we'll know. But yeah, so those are key things that I would say are great points.
Yeah, keeping a trading journal is something that I started doing after like year one, basically, and I think it's been super helpful for my development. And it also like it helps show. It's something physical that you can show yourself and your friends and
Yeah.
later
And
on.
it builds confidence too,
Yeah.
because um there's a lot of students that I work with. They'll message me the day of where they're not having a good day. They're like, "Bro, I don't know what's going on. I'm not getting it." And then I pull up their trading tracker and I'm like, "Well, I mean, you're sitting at like a 72% win rate. Your average winners are like 30% and your average losers are, below 20. So
Yeah.
overall, you're doing okay." And they look at it, they're like, "Oh, you know what? You're right. The numbers look good. I just
Yeah.
had a rough few days." And that's where that comes in, and also builds your confidence in your own abilities, right? A lot of traders doubt themselves and they rather follow someone on social media, which is crazy to me because they'll put their trust in someone they have no idea who it is,
Totally.
but but they won't track their own trades to build their own confidence for their own trading. Um,
Yeah, I
so
think like that just reminds me of another thing that I learned really early on. And it again, like it's another rule, another lesson that well, I don't have a rule really from it, but one thing that I learned was to trust myself. And it's sort of what you're talking about. Like you trust your own process. And
mhm,
there have been a few times in my trading career where I knew that this was an A+ setup. And I knew it based on my entire process that I'd done independently of, anyone else. And then I went to Twitter at the time, right? X. And I saw people poo pooing the name. I saw people like talking about selling. I saw people saying like, like posting different news sources or whatever, saying like, this is not a good stock. And I pushed pause because
mhm.
the flip side to getting your news on X is like you're getting your news on X.
Yep.
And I have learned that if I see an A+ setup, I just simply cannot like take my foot off the gas because some random person on the internet is telling me that it's a bad trade. Like I don't know what their process is. They probably don't even have a process. Like
Exactly, right? That's the thing, and like, it's like, it's unreal to me. It's unreal to me how I remember doing this as well, like, being a brand new trader, just trusting everyone on social media and thinking they have more experience or the more knowledge. That may be the case, but, their emotion, their account size, all that stuff is a factor that plays a big role in trading. Whereas if you spend, 5 months just tracking what you're doing and understanding who you are as a trader, you'll build that much confidence in your own abilities, where you'll be like, I don't need to get confirmation from Joe X and Y to tell me if this is a good setup. I know it is a good setup because I've taken this trade over 300 times in the past, 6 months.
yeah,
That's very important because at the end of the day, it's trial and error, and you got to learn what works with you, what sizes keep your emotions down, and what your risk tolerance is. So for someone, they might be trading lotto spy and their risk is 80%. For someone like me, I'm trading every day, my risk per trade is about 20%. Everyone's is different, and that is customized based on how much you can stomach for a loss, right?
yeah,
You talked about 10%, someone else talks about 2%. It's all a matter of how emotional will you be at the end of the day when you walk away from the computer at the loss that you think your unemotional, your perfect size is. So I always
Yeah.
tell people, if I go, what's the max you're willing to lose? Some people will tell me, oh, $1,000. I'm like, okay, so are you willing to lose $1,000 that day or $1,000 per trade? Then
Yeah.
they'll be like, oh, wait, maybe $1,000 per day. I'm like, all right, so that means you can probably take maybe 4 trades at $250 loss. They're
Yeah.
like, oh, okay, yeah, that makes sense. I'm like, great. Now, are you able to stomach that 3 days in a row? Right? Let's say you have a streak
Yeah.
of losses. Now you're out $3,000.
Yeah.
Can you stomach that? And then they're like, oh, you know what? Maybe not. Now we started at $1,000 per trade. Now all of a sudden we're sitting at around $75 loss per trade. So
Yeah.
that's how you got to look at it.
And that's something like you've been saying, that you only learn through experience, your own
Mhm.
personal experience. You got to be in the kiddie pool. You got to be in the pool trying to swim against the current. And one thing that I learned about myself is I tend to revenge trade after seeing a series of consecutive losses within a single day. And so, that tracking that, noting that, realizing that, and adjusting based on that insight helped me institute a new rule, which is that, not a new rule, it's an old rule for me, that if I have 3 losses in a day, like three trades that are not profitable, then I'm done trading for the day. Because
Yeah.
one thing that is really toxic in trading is that you start to there is a similarity to gambling, and that
Mhm.
it can easily become that if you don't follow your rules, if you
Yeah.
don't follow your process. And you get into this mentality, or at least I used to get into this mentality, like, oh, I can make it back, I can get back to even. That's a gambler's mentality. That's not a trader's
Mhm.
mentality. The
Yeah.
trader's mentality says the market will be here forever. Tomorrow will present new opportunities. I don't need to do this today. I can take a break. I have the freedom to go for a run. The market will be here every single day for the rest of my life. And I really subscribe to that mentality, so that I don't become a slave to the market. You do this for freedom. You don't do it to become a slave.
Exactly, man. I think that's a great point to kind of end off on. I do that all the time as well. 3 red trades in a row, you're not seeing something clearly today.
Yeah,
I don't whether it's something personal that's bugging you, whether something's going on, you're clearly against the trend, something's happening. You haven't earned the right to take a 4th trade. And I'm the same way. If 3 trades that are red, see you later. I'm shutting it down. I'm not looking at anything. I know tomorrow is going to be a better day, and that's where you got to come back. You just got to be able to walk away there, and that's managing risk, right? Keeping
yeah,
your emotions down, managing risk, and not sitting in front of the computer all day. We don't want to be. We don't want another 9 to 5 staring at monitors all day long.
exactly. No, it's
Awesome, man. Josh, it's been an hour of amazing things. I think we talked about some awesome stuff here, some great gems. Any final notes, any final thoughts?
no, just that you're the goat, like someone said in the comments, Ali the goat.
You're the GOAT.
And really appreciate your input into the community. I think there's been so many bad people that it's hard to separate the good from the bad people if you're
Yep.
anonymous.
Mhm.
And I think that your face, your presence, your mentality is just super helpful in the midst of that. So thanks for what you're doing.
Appreciate it, man. Thank you. Thank you for all the knowledge. Thank you for all the gems. We hit a record number of 534 viewers today. That is awesome. That is awesome. That beat my old record. So let's go, Josh.
That's awesome. Let's go. Yeah, follow me on Twitter. Watch Josh trade. I don't
Yes, give
really
him a
run it.
follow. Watch Josh trade. He's awesome. He had a banging day today. Um,
Big day.
and
Big day.
yes, yes. Hopefully, we'll make more of these. And hopefully, you guys tune in. And surprise for those of you guys that are still listening, this is recorded. You will all be able to watch it. Just putting a little bit of fire underneath your butts so you guys tune in and commit to something. And that's trading. Love you guys. Thank you for watching. And we'll catch you on the next one.
See you guys.